Good morning, afternoon, or evening, depending on where you are in the world. Welcome to the Metrics That Matter webinar. I am your host for today, Constance Coral of Supply Chain Insights. In the next hour, you will hear from founder and CEO of Supply Chain Insights, Lora Cecere, on the latest research findings in supply chain metrics that matter by industry. Today's Twitter hashtag is SCI Webinar. We encourage you to share your thoughts and nuggets of information in the social networks. We also want to hear from you. So please message your questions in the Q&A section addressed to panelists. We will compile your questions and ask them as we move throughout today's webinar. At this time, I would like to welcome Lora Cecere.
Hey, thank you so much, Constance, and it's great to be online today to share some of the research that we've been working on the metrics that matter. And I would encourage folks to follow our Supply Chain Index blog authored by Abby Mayer, and also she's on Twitter at IndexGirl as we go along if anybody has any questions. So metrics that matter. This research started about 17 months ago when I had a client and he said, Laura, I just don't know which metrics matter. And I said, to what? And he said, well, to market capitalization, to the ability for me to add value to my company. And so this research initiative has started from client request. And you know, it also started because, you know, in our research we find that many companies are like this man on this moving sidewalk. The processes and technologies have helped them to move faster, but they're not clear where they're going. And we find that 9 out of 10 companies are actually stuck in their ability to drive faster and better progress in supply chain. And so while we say that, you know, supply chain's 30 years old, one of the things that I challenge clients to do is to learn what we've done in the past, to unlearn, to relearn, so that we can rethink where we're headed in supply chain to better manage the supply chain as a complex system. So who are we? Well, Supply Chain Insights is a small firm, and we're focused on delivering independent, actionable, and objective advice for supply chain leaders. We're very focused on the line of business user, and it's all about research. We're not a consulting firm, and everything that we write is in front of the firewall. When I first started to write the book Bricks Matter, which has now been out for the last year, and we've got 17 5-star reviews on Amazon, it was a celebration of 30 years of supply chain management. And when I sat down at the kitchen table, I thought, let's write a book to celebrate 30 years of supply chain, that we have reduced inventory, improved customer service, and improved cost. And what I did was I started looking at balance sheet data and income statement and started looking at benchmark data, and what I found was that only one industry segment had reduced inventory, and that most companies were stalled on cost, and also they were stalled on their ability to manage the supply chain as a complex system, managing customer service. In fact, I find that most companies overstate customer service. And so when I wrote the book Bricks Matter, it was really to say, you know, what has happened in 30 years is important for us to learn. But as we think forward, and we're currently working on the book Metrics That Matter, which will publish in September 2014, and in the book, Metrics That Matter, we'll be taking each industry and we'll be looking at the metrics that have mattered to that industry, and we will plot the paths of the industry leaders, and I'll show you the methodology today, and we'll be characterizing the progress based upon case studies of supply chain leaders. So if you're interested in being in this book, I'd love to talk to you about it. What we do is we benchmark your financial results, and then we interview you, and then we work with you on your interpretation of the results as it ties to your company. So look for this book in September 2014. We're in the middle of the research for it, and I'll talk to you about what that looks like as we go along. So supply chain today. two big problems: the ability to get data and the knowledge and understanding of the supply chain amongst the executive team. Many of the supply chain teams today don't know how to talk the language of the balance sheet or the ability to translate what they do in supply chain to the actual metrics that matter. And this understanding of the supply chain as a complex system is a struggle for supply chain teams. We tend to talk our language, our yada yada, our acronyms, and people see us as, sometimes whiners or sometimes boring. And so one of the goals of this research is to help supply chain leaders better talk the language of business, and to recognize that the supply chain is a complex system with complex processes and increasing complexity. In fact, one of the main reasons why 9 out of 10 companies are stuck is the fact that complexity has risen without the design of the supply chain to manage it as a complex system. And our processes are complex, yes, but what we need to do is design them so that we can enable the rising complexity to basically service demand. And so we write about a concept called the supply chain effective frontier. So as we work on this complex system, companies want to balance growth, and growth is harder these days. We don't have the go-go years that we saw in the 2000 to 2003 period. And one of the things I'm working with companies on is how the supply chain can enable growth and how we can drive better processes to drive growth through better sensing and enablement of supply chain processes. But we also need to balance growth with profitability, and typically the back office functions where supply chain is are saddled with cost and really seen as the bank to drive home profitability. But we've got to balance profitability with cycles. This would be inventory cycles, working capital cycles, payables, receivables. And so what we find is that many times companies will be very functionally aligned, with supply chain focused on profitability, marketing and sales focused on growth, and really cycles, or the management of inventory, is really nobody's role. In fact, it falls between the cracks, often being a symptom of an out-of-balance supply chain. And then we already talked about complexity, that we have a rise in complexity across the industries, and many companies are not able to show the impact of complexity and how these trade-offs need to be handled in the design of the supply chain. As complexity rises, it's even more important to design the supply chain for it. So which metrics matter? This is the work that we've been doing over the last year, where we've been looking at a database of 20 financial ratios that are divided by growth, profitability, cycles, and complexity. And what we find when we take the supply chain financial ratios and we do analysis around correlations to market capitalization, these are the metrics that matter. 88% of industries have a correlation to days of inventory. Likewise, 88% have a correlation to days of sales outstanding. Days of payables are next. Return on invested capital also is high at 75%. Current ratio at 63%. Operating margin at 63%. But then down at the end is return on assets. And many companies have used return on assets as a de facto measure to measure profitability, because only 23% of companies can easily measure profitability. It is not as good of a measure. Also, you can see that growth also does not correlate for most industries. So as we're dealing with market capitalization, if that is our goal, which is the number of shares outstanding times the value or the price of a stock, if that is our goal, these are the metrics that matter. Most companies want to improve the market valuations of companies. And so what you see there at the top are the management of cycle metrics. But how have we done? If we look over time and we look over the last decade, what we see is that we stack rank by operating margin. Pharmaceutical and medical device companies have had the luxury of very high margins, then consumer packaged goods followed by food, then consumer electronics, which have been hit hard with the changing product life cycles, and then apparel, and then the chemical industry, and then the automotive industry. And if we look at the average cash-to-cash cycles, and we look at the change in the cash cycles, and again, we want to have a short cash cycle, but we want to have a large inventory turn. You can see that the cash-to-cash cycle for pharmaceuticals actually went up 25%. And while their inventory turns got better, it's sort of like The Biggest Loser. They're starting from a very low base. Whereas consumer packaged goods actually was able to remarkably improve their cash-to-cash cycle. However, a lot of this is coming from payables, which is pushing waste and costs backwards onto their suppliers and causing some out-of-balance conditions, but they're also improving inventory turns by 9%. Probably the worst of the lot is apparel, which is not only struggling with a lower operating margin, but also, as you can see, slightly increased cash-to-cash with very high values, not very high inventory turns, and they're not making progress on inventory turns overall. And then probably the next worst is automotive, which is struggling with very low margins. They also have improved cash-to-cash, primarily through payables, causing weakness in the suppliers. And they're also not able to improve inventory turns. So one of the things that we're looking at in the writing of Metrics That Matter are the case studies around balance and how companies have achieved balance or have not achieved balance over the last decade. You can't put all industries in a spreadsheet and shake them up and declare a winner. It just doesn't matter if we have to generalize things. It's very industry specific. Now, when we look at progress in manufacturing productivity, and some people will say, well, Laura, how do you know the revenue? And this revenue actually comes off the balance sheet. And so these are full-time equivalents that are reported on the balance sheet. And if we look at consumer electronics and pharmaceutical companies, they have had the best year-over-year changes in productivity, followed by chemical, and then, the laggards are apparel and medical device companies. So why have consumer electronics done so well in driving productivity? Well, one of the reasons is outsourced manufacturing. Pharmaceutical companies have been able to get global scale and they have contract manufacturing. Chemical companies have really gotten at it through merger and acquisition and global scale. So again, we see that apparel companies are our laggards and that the medical device companies, which have very high margins, have not been able to improve productivity. Now in retail, we find that not only is there not a lot of change, but it's pretty flat year over year. Retail has not been able to get the same levels of productivity that we see from manufacturing. And a lot of this has happened because e-commerce is taking the profitable, the very low labor input orders off the top and putting more pressures on the store, which is causing an imbalance in labor productivity. So overall, this is how we rank the industries. And we find that 9 out of 10 companies are stuck in their ability to drive progress on the effective frontier, to balance growth, profitability, and cycles, and that they're not able to really drive this forward, which is causing us to have to rethink processes and analytics to be able to move from inside out traditional processes that have a dependency on orders and shipments to sensing systems that are outside in, that really help us to match product attributes and customer attributes and translate demand and sense supply and design the supply chain. So we see that consumer electronics has the best balance, followed by consumer packaged goods, followed by chemical, and then we see the transition. And we've done a lot of writing recently about the healthcare industry, and it's a problematic industry because we really haven't had any leaders step up to the plate to drive progress. So what is supply chain excellence? Our point of view is that it's when companies perform better than a peer group. They have year-over-year results. They align on the metrics and it ties to the business strategy. They show consistency in year-over-year progress. They drive new innovation, and they're balanced. And as we move in our making of the case studies for the book, what comes across really clearly in the case studies is leadership is defined by supply chains that are resilient and predictable, and I'll show you examples of this in the case studies we're going to go through today, where we have very tight patterns of year-over-year growth and very predictable results. Where we have a lack of supply chain excellence is we see a lot of wild swings and a lot of financial intervention where people are setting financial targets that are really not based upon the potential of the supply chain. The other thing is we see that the metrics are balanced, that companies aren't looking at singular metrics like inventory turns or cash to cash in isolation, but they're looking at the metrics holistically across the portfolio and trying to balance what matters to them and their strategy and looking at how all the metrics can improve. I'm working with a client right now that's done a great job on improving profitability, but they don't believe that they can improve profitability while improving customer service and improving inventory. And that really is cultural to be able to look at, can I improve the potential of the supply chain through the design to be able to raise the balance of the metrics together and showing year-over-year improvement. So to do this, we've built a database of 20 years of financial data, and these are the ratios that we're using. And again, we're using ratios. We're not using straight financial data. And the reason is that the ratios allow us to compare big companies to small companies, allow us to compare companies across different currencies, and they allow us to be able to look at the trends more holistically. So if you're interested in financial benchmarking, that's a service that we offer, we would be glad to talk to you about doing that. We find in these ratios the most interesting patterns, and you know, Abby Mayer, who works on my team, has done hundreds of these for me, and we find that the most interesting patterns are at the intersection of revenue per employee, which is a productivity measure, versus inventory turns, operating margin versus inventory turns, and cash-to-cash cycle versus inventory turns. And one of the reasons why the cash-to-cash cycle versus inventory turns is so powerful is it allows you to see which companies are artificially moving cash-to-cash by increasing payables versus those that have the discipline to improve the inventory turns. So with that, let's talk about progress. Are we making progress? What we did was we took all the public companies in the database and we said, let's look at industry sector and let's say which companies have made progress in both inventory turns and operating margin. And of those companies, were they able to do it for 1 year, for 2 consecutive years, for 3 consecutive years, for 4 consecutive years? And what we see is that on average, about a third of the companies are able to drive progress at inventory turns and operating margin for 2 years. But 3 years, well, falls off dramatically. And 4 years, almost non-existent. So what we see is that at the intersection of inventory turns and operating margin, where supply chain discipline really matters, it's very hard for companies to have year-over-year progression. Often we'll have a project that we put in place and that project will improve for a short period of time. But balancing complexity with inventory turns and total cycles with profitability is a tough nut to crack without a real change in what we're doing. Now, interestingly, companies become very disciplined with the recession. In fact, when you look at this chart, the green bars represent the recession, and when we look at the number of companies that were able to demonstrate improvement at the intersection of inventory turns and operating margin, you can see that right at the end of the recession, we tend to have more companies that are actually responding and improving at that intersection. When the going gets tough, we tend to do better, but our ability to sustain it is a greater challenge. So what have we learned from this analysis? Number one, each industry has a unique pattern of trade-offs of growth, profitability, cycles, and complexity. Don't waste your time putting all the industries in a spreadsheet and shaking them up. They're just too different, and I'll show you some case studies to help you see the patterns. The thing that really surprised me is that the leaders have very small movement year over year with balanced portfolio of metrics. They have resiliency, and that's very, very small improvement. And so you've really got to take a long-term view. When I was interviewing case studies for Bricks Matter, one of the supply chain leaders said, Laura, I don't think we can make any change in less than 3 years. And based upon what I'm seeing in the analysis of the data, I really question if it's more like 5 years. You know, and some industry analysts will tell you that it's all about return on assets, growth, and inventory. I'm sorry, that does not defend or define supply chain excellence. We do not find return on assets has the correlation. We don't find that growth has the correlation, and we've really got to look at it as a complex system. So with this, let me go through some case studies to give you some perspective. Now, to look at the case studies, let's first align to visualize the patterns. What we're doing in the two-dimensional intersections on the case studies I'm going to show you is we are plotting a measurement here, it's inventory turns, against another measurement, which here is revenue per employee. And what we're doing is we're showing the progression of the company. So this is Dow, and we show the average of each of these intersections. So Dow, for this period of time, had an average of revenue per employee of 999, and they had an average of 6.7 inventory turns. But you can see there is some circular movement around the recession and around the Roman Haas acquisition. However, Dow is a leader in productivity. So this is how you read the charts. And with that, let's go into some of the analysis. Let's start with PepsiCo versus Coca-Cola. PepsiCo is a larger company, and larger companies should get economies of scale by their market presence and their ability to manage complexity. They're much larger than Coca-Cola, but both are very global companies. So if we look at the intersection of inventory turns versus revenue per employee, there are a couple of things to look at. Number one, look at the lack of resiliency of Coca-Cola, which is KO. Not only are the numbers lower for inventory turns, 5.4 versus 8.2, but look at the pattern and the fact that we're going backwards on revenue per employee, and we're really not making progress on inventory turns. Now, on the other hand, if I take PepsiCo, I would question why PepsiCo is not leading Coca-Cola on productivity due to scale, and I would also want to know what have they done in the last 3 years that's improving inventory turns. And in fact, that is actually the work that we're doing as part of Supply Chain Insights, trying to get under the numbers to understand what's happening. And PepsiCo has done a good job of the use of downstream data, looking at channel data, working with retailers. Definitely a leader, was much more aggressive in going after this technology than Coca-Cola. Likewise, Coca-Cola made some changes in distribution strategy, buying and selling bottlers, which dramatically changed these results. Let's take another example. Again, we have to look at peer groups. So General Mills versus Kellogg's. Relatively the same size, relatively the same geographic operations. Again, if we look at revenue per employee versus operating margin, which is a different intersection here, one of the things that we can see is that both companies are improving in revenue per employee, but General Mills actually has made a choice to be able to make a trade-off, an operating margin for market share. That's a conscious choice. I have a lot of respect for General Mills. Whereas Kellogg is really struggling for operating margin, and it's not a conscious choice. And if you look at inventory turns, General Mills has made recent progress on inventory turns. Now, again, when I showed the companies on the effective frontier and those that were making progress, household products rank next to consumer electronics. And I want to show you what leaders look like and what we can learn from leaders. And then I'm going to show you the chemical companies and allow you to contrast a difference in resilience and balance with household products versus chemical. So when we look at the companies of Procter & Gamble and Colgate and Unilever, you know, what we see is that Procter & Gamble is the revenue leader here, and operating margin was fairly flat up until the years of 2011 to 2012. Colgate, which should have less scale than Unilever, is actually doing better on revenue per employee, punching above its weight class, and is actually driving improvements in operating margin. In fact, in my study, I cannot find a company that has done better on operating margin and year-over-year improvements than Colgate. But let's take a look at Unilever. Unilever has not been able to get the revenue per employee, and we actually see a downturn in Unilever in the last year. GlaxoSmithKline is shown here for reference because what we see is in the over-the-counter drug companies that we see much higher margins, but again, we see a decrease in operating margin here. Now let's look at inventory turns versus revenue per employee, another cut at the data. Here you can see that Procter & Gamble is actually improving in inventory turns, whereas Colgate is stalled, and Unilever is making progress in inventory turns. This is very characteristic where you see a company making a choice right now between inventory turns versus operating margin, which requires the redesign of the supply chain to be able to improve the potential to be able to balance both. Now let's look at Target versus Walmart. What we'll see here is that Walmart is the better performer. So if we look at revenue per employee versus inventory turns, what we see is both companies are actually seeing a decrease in inventory turns based upon the market dynamics with the increase in e-commerce and the changes with what's happening with Family Dollar or the dollar stores. But we can see that there was a tremendous improvement on inventory turns for Walmart up until the last 2 years. However, then revenue per employee, Walmart is outpacing Target. Now let's look at inventory turns versus operating margin. Walmart's stuck on operating margin, and Target shows a real lack of resiliency. Walmart was bringing down the inventory or improving the inventory turns up until the last 3 years, but in the last 3 years they're stuck on both operating margin and inventory turns. If we look at cash-to-cash versus inventory turns, which is a very useful analysis because it helps you to understand how the supply chain is performing, you can see that Target has a lack of resiliency in that pattern, whereas Walmart was bringing down the cash-to-cash while improving inventory turns, which is a characteristic of supply chain leaders, improving both in the period of time here. So who did this best, Target or Walmart? I believe that Walmart was much more balanced. Now let's look at the chemical industry. What we find in the chemical industry, because the chemical leaders are further back in the supply chain, they have more distortion with the bullwhip effect, and they're not as good at demand sensing. Let's characterize 2 chemical companies, BASF and DuPont, and look at the changes that we see in the year over year. First of all, if we just look at cash-to-cash cycle, which many supply chain leaders make a mistake of just looking at singular metrics, and you've really got to look at the metrics at a total portfolio balance. You'd say they're doing about equal, but The story is in the data. Let's look at revenue per employee versus inventory turns. If we look at revenue per employee, BASF has not done as well as Dow, which Dow is not shown here, but BASF has outperformed DuPont, and you can see that they've also been able to improve inventory turns with the exception of the last year. DuPont, on the other hand, has not been able to get the productivity that other chemical companies have, and they've actually shown a lack of ability to improve inventory turns over this period of time. But when we look at inventory turns versus operating margin, which is a litmus test of a supply chain leader, what you saw in household products and what you saw in the retail sector of mass merchants was a clear pattern. You didn't see the oscillating pattern that you see here with the chemical companies. And what you see for DuPont is a much wider oscillation, a lack of resiliency. And also what you see in BASF is it's actually turning in on itself. So the ability to manage operating margin and inventory turns is a struggle for the chemical companies to a higher degree than it is for household products or mass retail. Now when we look at cash to cash versus inventory turns, which cash to cash, of course, we want the cash to cash to be low, and of course, we want the inventory turns to be high. When we look at the cash to cash positions of DuPont, we see that they're going backwards in inventory turns, even though they have some improvement in cash to cash. And again, it's a change in payables. When we look at BASF, they've made true supply chain progress, and it's more year over year. And even though they had a little backslide in the 2011 to 2012, it is the pattern of a more representative supply chain leader. Now, I also want to contrast a case study we've been working on. It's a packaging case study of two packaging companies, and there's a couple of points that I think are really relevant from this case study. Number one, they're about equal in size. They're both packaging companies, and so they're in the bullwhip effect, feeding the packaging of food and consumer packaged goods. Both of them have a lot of complexity, as we've added 30 to 40% of items in their upstream supply chains. You can see that Owens, Illinois has a $62 million research budget and Sunoco Products has a $20 million. But look at the difference in the days of inventory. And there's a dramatic change in where they are on the levels of sales and operations planning. Owens, Illinois is still working on the feasible plan, matching demand and supply, where Sunoco Products is looking at how do they visualize the asset utilization and really shape demand in the market to be able to sell what is the most profitable mix of products. And when you look at the differences here, what we see is Owens, Illinois, you see an oscillation here at the intersection of operating margin and inventory turns, whereas we actually see that while Owens, Illinois has the oscillation, Sunoco Product has a very tight pattern, and even though they have lost some ground on operating margin for growth, they've had a better year-over-year inventory turns. So what do I want for you to take away from these crazy graphs that I'm showing you? Number one, never look at a metric in isolation. It's about a balanced portfolio. Number two, supply chain leaders have very tight patterns with year-over-year progress at the three intersections of profitability, cycles, and also complexity. And third, supply chain matters. Underlying these metrics are strong supply chain practices, year-over-year progress, very disciplined. Supply chain is measured in very small increments, the excellence. And when we say year-over-year improvements, those are hard-won for supply chain leaders. Now, at Supply Chain Insights, we're continuing our work on the Supply Chain Index, and we will be finishing this up for our 2014 Global Summit. And what we're doing is we're working with Arizona State University in the January period, where we're working on trying to get predictive models that allow us to have a formulaic representation of how companies are trading off growth, profitability, cycles, and complexity against market valuation. And this work is continuing, and its start of the work was, again, the metrics that matter based upon the correlations. But what we're trying to do is to come up with a formula so that supply chain leaders can better talk the language of business. We were able to get predictive models in the last 3 months for 3 of the industries that we cover: household products, discount stores, and medical care. But we had some distortion in the data, and we continue the work, and we look forward to finishing up this work with Arizona State. If anybody would like to know what these formulas are, we'd be glad to share them. But here, what we did was we actually looked at the R-square value, and of course, the better the R-square, the more closely it correlates. But also what we did was we took 6 years of data, and we used years 1 through 5 to predict the 6th year, or 2012, to say what is our mean absolute percent error. So we still have work to do, but we're not giving up on the index. We still want to crack this nut, and so we're continuing to build the database, deal with some of the data sparsity issues that we have, and also take it to SIC and NAICS code analysis versus the Morningstar Index. When we did this analysis by the Morningstar Index, we actually introduced noise into the analysis, and so by going back to a straight SIC code, NAICS code analysis, we reduced some of that noise. This work is ongoing, and we will be publishing on this work in our Metrics That Matter book and also at our conference in 2014. So I come to the phone today to say supply chain is a complex system with increasing complexity. Never look at singular metrics in isolation. Do two-dimensional graphs to see what those year-over-year patterns are, because different industries have different patterns. But the cash-to-cash metrics have the highest correlation to market capitalization with some of the poorest performance. We're now in a new decade of supply chain management. We need to redesign supply chains to be able to have better balance on the effective frontier, to better balance our inventory turns and our cash-to-cash and put discipline around it. It's not sufficient just to measure levels of inventory. We've got to look at form and function of inventory, push-pull decoupling points, and the design of the supply chain to better balance these metrics. So with that, I'm going to wrap up. We are continuing the work on the supply chain index. We will place the rankings on public determination on our analysis of balance of the companies and their ability to balance on the effective frontier, the strength of the values and the patterns, and the resiliency into the Supply Chain Insights community in the spring. And we'll be asking Shaman Circle members to vote on which of the companies they feel actually represent supply chain excellence. And our final analysis of this will be rolled out in the 2014 Global Insight Summit. It's our goal that this methodology can go across all companies, not just the Fortune 1000, and that it can be very powerful and meaningful by industry, because, again, I think that we really have got to be able to look at industry patterns over the last decade and why supply chain matters. We're continuing our webinar series, and we have 2 webinars that are coming up in November. One to talk about what's happening in the Shaman Circle, and the second to talk about the healthcare value chain with some special guests. And digital manufacturing and 3D printing will be December. And then in January, we'll be talking about the state of technology. So with that, Constance, do we have any questions from our audience?
Not at this time, but I will open up the floor to our audience if you have any questions. We have a couple of minutes here for Lora, and I'll work on the supply chain index and metrics that matter. As Laura mentioned, our upcoming webinars are November 13th. We have some special guests, Marty Kislick, Global Supply Chain and Manufacturing Director of FMC, and Karen Smith, VP of Operations for Jockey. They're going to be sharing their insights on an upcoming executive level event called the Shaman Circle. And November 14th, we will be discussing our latest research report on healthcare value chain. And you can find all of our details on our webinars on our website, supplychaininsights.com. Laura, I don't believe we have any more questions at this time. Do you have any last words for the audience?
Well, I just want people to know that this is a journey. We're working hard on this data. And the other thing is we will culminate this next year of research at the Global Summit with all of the case studies, which will be held on September 10th and 11th in Scottsdale. And we're continuing our public training on how supply chain excellence actually culminates for companies. And every company that attends this will be able to get their own financial benchmarking and be able to share that with other participants in the public training class. And then we also have our podcast series, which, Constance, is great to see 50 podcasts that we've archived. It looks like we actually have a question. One question is, can I expand on S&OP maturity and its link to the metrics? And I thank Michael for the question. You know, one of the things that we see in the definition of sales and operations planning is that companies go through 5 levels of maturity. The first level of maturity is, can I just have a feasible plan? The second is, can I match demand and supply? Then I go to the determination of profitability, which many people call integrated business planning. And then I start going outside in to manage the channel, to look at how I sell through the channel and how I manage the entire value network, which is a shift in levels 4 and 5. As I move on maturity on these horizontal processes, I'm able to get better balance on the effective frontier. I'm better able to look at complexity. In fact, I see some companies actually doing a measurement of complexity and either forecastability on the demand plan or the impact on changing product assortment and mix on profitability or on velocity in the channel. And S&OP is a wonderful way, when it's effective and it's balanced, to be able to manage complexity with inventory turns and cost. However, Michael, we only see that 20% of companies are balanced. Most companies are either very strong on the OP or the operations or very strong on sales and marketing, and they don't understand the need for balance. And so one of the things that we've been working with companies on is, how do they get balance on these metrics? I hope this helps. Thanks for the question. Now, well, I also have.
Yeah. I think you have access to the questions as well. Yep. We have a couple more questions. Gwen would like to know, do we have any intention to look at perishable products?
Yeah, in fact, you know, we see that in food and beverage in particular that we've got a lot of open code date products, and that does have a tremendous impact on both cost and also inventory cycles. And in the book, we'll actually be looking at perishable products and some of those trends. We also see with pharmaceuticals going to more cold chain and more custom drugs that there tends to be more perishable products. And it's my hope that, you know, like consumer electronics learned how to deal with perishable products because, you know, the short life cycles of the supply chain of consumer electronics and the fact that those products lose margin the longer that they're in inventory, it's my hope that companies can learn from what consumer electronics have done to improve the effectiveness of perishable products. But for most companies today, it's added complexity that they haven't really been able to deal with. Constance, any other questions?
One more from Wilbert. He wanted to know, what impact does regulatory agencies have on the data for pharma and medical?
Well, clearly what we find is that with regulations, and particularly the fact that there are so many different regulations across the globe, and the fact that most companies are, seeing more and more regulations year over year, clearly the regulations have an impact on the ability to manage inventory. However, what we find from our interviews is that because these industries have had very high margins, most of the supply chain executives say that inventory just has not mattered as much, that they haven't had to really grow the muscle at the core. And I think that, when we look at the entire value network within healthcare, one of the things that we see is that hospitals have actually improved inventory turns, shifting the responsibility for inventory backward to the suppliers. And the suppliers haven't gotten the value because they've not actually gotten the case management or the usage data to be able to manage the entire channel. So it's a good case study, I think, where the entire value chain is stuck, where we're not able to reduce the entire value chain for inventory, although regulation clearly plays a role in that added complexity. Thank you, Wilbert and Glenn, for your questions. Any other questions, Constance?
I think that is all for now, Laura. Thank you so much for taking some time out of your busy schedule to explain to us the metrics that matter. And thank you all out there for attending. We had a very good attendance, and we are recording this for those who were not able to see this live. This will be available on demand. You can pass it on to your network. That'll be available within the next 24 hours on our website, supplychaininsights.com. We also will have Laura's slides available on Lora Cecere's SlideShare, and you can find that in the next couple of hours as well. So with that, thank you so much for joining us. I really do hope to see you next time at our Shaman Circle webinar as well as healthcare webinar. And thank you very much for participating. We'll see you soon.